Welcome to Limited Company Property Finance. I'm Georgina, and this is the show where we explain how landlords actually fund property inside a company in plain English for investors, portfolio landlords, and anyone weighing up the company route. Today, we are setting the scene for 2026. Why the limited company has become the default structure, how a company buy-to-let mortgage really works, and the funding routes that go with it. Let's start with the shift, because it is one of the biggest stories in the rental market. For higher rate landlords holding property in their own name, Section 24 removed full mortgage interest relief, replacing it with a 20% tax credit. Inside a company, mortgage interest stays fully deductible against corporation tax. That single difference has moved the market. By the end of 2025, there were around 443,000 active companies set up to hold buy-to-let property on the company's house register, according to Hamptons, nearly 5 times the number a decade earlier. A record 66,587 new ones were incorporated in 2025 alone, and Hamptons reckons around 3/4 of new buy-to-let purchases are now made through a company. Paragon's data points the same way. About 43% of mortgage buy-to-let purchases completed in a company in 2025, up from 35% the year before. One important note before we go further. Whether to incorporate is a tax decision, not just a finance one. Everything we say about Section 24, capital gains tax, the stamp duty surcharge and incorporation relief is general information, not tax advice. Please take advice from a qualified accountant before you act. Now here is the single most important idea in limited company property finance. A company buy-to-let mortgage is a loan made to a company, almost always a special purpose vehicle. An SPV, registered under SIC code 68100 or 68209, that exists only to hold rental property. The company borrows, the rent services the loan, and the directors give personal guarantees. Lenders price a clean property-only SPV best, and a brand new company with no trading history is not penalised. The numbers work a little differently inside a company, and mostly in your favour. Company buy-to-let is usually stressed at a 125% interest cover ratio, against the 145% applied to higher rate personal borrowers. That lower cover requirement is the core advantage in the arithmetic. The trade-off is a small rate premium, currently around 0.20 to 0.40% over the equivalent personal product, a gap that has narrowed as the company market matured. For most higher rate landlords, full interest deductibility more than outweighs that premium. But again, that is a calculation to run with your accountant. So who lends? This is a specialist market, and it is where a broker earns their keep. The active SPV lenders include names like Paragon, Kent Reliance, Fleet Mortgages, Foundation Home Loans, Landbay and Precise. Just as important are the intermediary-only lenders, the Mortgage Works, Leeds, Coventry, Metro Bank and Yorkshire Building Society, that you simply cannot approach directly. You reach them through a broker with whole-of-market access across a panel of more than 100 lenders. Let's walk through the routes. First, the core SPV or limited company buy-to-let mortgage, up to 75% loan to value, a handful of lenders at 80% on a premium. Second, transferring an existing portfolio into a company. This one matters. Moving personally held property into a company is a sale at market value, so it can trigger capital gains tax and the stamp duty surcharge, with incorporation relief available in some cases. It is a taxed event, very different from simply buying your next property in a company. We arrange the mortgage leg and work alongside your accountant. Third, limited company remortgages, switching at the end of a fix, or capital raising on company-held equity to fund the next purchase, re-stressed at 125% on the current rent, so rent growth since you bought can release a larger loan. Fourth, HMOs and multi-unit blocks inside the company, where the valuation basis, room rate income or commercial yield matters more than the headline rate, and the cover test clears with real headroom. Fifth, SPV bridging and refurbishment, for auctions and unmortgageable stock, with a pre-agreed exit onto a company mortgage once the property is let. And finally, portfolio and group finance. For landlords with 4 or more mortgage properties, with whole portfolio rental schedules and an aggregate stress test alongside the per property cover. If you want the detail, we have built a full set of guides covering SPV and limited company mortgages, transferring property into a company, remortgaging, HMOs, bridging and refurbishment, structure and personal guarantees, and portfolio finance. You can find them linked from this episode and at limitedcompanypropertyfinance.co.uk. A final word before we finish. This episode is general market commentary, not financial advice and not tax advice, and not a quote or an offer. The figures are indicative and real terms are set case by case by individual lenders. Buy-to-let lending to a company is, in most cases, unregulated business lending, so do take professional advice for your own situation. That's our 2026 overview. I'm Georgina. This has been Limited Company Property Finance, and we'll see you in the next episode.